and welcome to EisnerAmper's Private Equity Dealbook podcast series. I'm your host, Elana Margulies-Snyderman, and with me today is Bob Esposito, Managing Director in EisnerAmper's Transaction Advisory Services Group. Today, Bob will share his outlook for deal-making in the life sciences industry, including the greatest opportunities, challenges, and due diligence considerations. He will also discuss what private equity managers look for in the buy-side process to better ensure that both a mutually beneficial and efficient transaction can be consummated in today's economic and transactional market environment. Before we dive into the conversation with Bob, don't forget to hit that like button and subscribe to EisnerAmper wherever you listen to your podcasts. And you can also find us on YouTube at EisnerAmper. Hi, Bob. Thank you so much for being with me today.
Good afternoon, Elana. Thank you for having me.
Absolutely, Bob. So to kick off the conversation, tell us about yourself and how you got to where you are today.
Thank you, Elana. I started my career in the Big Four working for KPMG. I was with KPMG for 35 years, 25 as a partner. And during that tenure, I served as the national partner in charge of life sciences for KPMG, as well as the national partner in charge of transaction services for the life sciences sector. I retired from KPMG, took a little bit of time off where I went back, got my master's in accounting, and then subsequently joined EisnerAmper, where I joined the Transaction Advisory Services Group 13 years ago, working full-time in supporting our clients on their transaction needs, and currently serving as the national practice leader of EisnerAmper's Transaction Advisory Services practice.
At EisnerAmper, we are creative problem solvers that take a 360-degree approach focusing on you. We're an award-winning firm with decades of experience. EisnerAmper, let's get you ready.
Bob, so on this podcast, we're discussing deal-making in life sciences. I would love to hear your high-level outlook for the space.
It's a very exciting space, Elana. I've always been of the belief that all companies in the life sciences sector are doing deals and need to do deals to survive. And I define life sciences as the product side of healthcare: biotechnology, pharmaceutical, medical device, medical equipment, pharma services, and diagnostics. Companies need to do deals to access financial capital, technology capital, workforce capital, geographic market access, and ease of regulatory approvals. So you'll see companies in all different forms and shapes doing deals, whether it's a real startup company or a company like Johnson & Johnson, which is the global leader in healthcare in terms of size and breadth. In terms of where the market's been so far this year, it's been a fairly robust first half of the year.
And Bob, more specifically, I know you touched upon a lot of different themes, but what are some of the greatest opportunities you see going forward and why?
I think the greatest opportunities, Elana, are going to be with those companies that have the least risk profile. And that would be primarily in the pharma services sector. Pharma services being contract research organizations, contract manufacturing organizations, contract sales organizations, clinical testing labs, companies that have a defined revenue base, a sustainable revenue base, and their ability to generate revenues in time to market is much less risky than the longer stage of biotechnology and branded pharmaceutical investments. We also see the medical equipment and medical technology sector being more near-term opportunities. There are many companies in that sector, including diagnostics, that have developed excellent technology, but they don't have the overall critical mass or the resources to be able to have follow-on investments or to be able to get critical mass in the marketplace. So we're seeing private equity firms, and in some cases corporate firms, that are going in and looking to consolidate some of the middle market, smaller stage medical device, diagnostic medical equipment companies to build larger portfolios in companies, larger corporates, or in the larger private equity funds where they can build a portfolio of companies that can support a larger platform. We see the biotech and the pharmaceutical sector. There will always be deals in that sector, but again, they're going to be longer term, fewer in number, larger in size, taking much longer to ultimately come to market. So we see the investors, primarily the private equity funds, looking for companies that have a defined revenue base, a path to cash flow or existing cash flow, and a quicker return on investment and potential exit strategy because those companies have a defined product or service. That service and product has a sustainable revenue base that they can quantify, and there's less risk of regulatory failure.
Bob, on the other hand, what are some of the greatest challenges you face when it comes to deal making in life sciences?
Well, I think the greatest challenge is life sciences, by definition, is a risky, challenging industry sector because we're creating new products and services to meet unmet medical needs. And that's always a challenge from a scientific, research, clinical, regulatory perspective. But if you overlay that, Elana, with what's happening in the marketplace with tariffs, the threat of tariffs, which is increasing the cost of products and services that these life science companies need and use in order to perform their R&D and bring their products to the marketplace. Some of the geopolitical trade barriers, as there are negotiations going on between the United States trade commissions and some of the foreign countries, there could be some interruption in terms of being able to have global flow back and forth between the United States and other countries. Most of these companies are developing products that really need a global market in order to support the large R&D investment that they've incurred. They can't just survive on having a U.S. or a domestic market. They really have to have a global marketplace. So the ability to be able to trade imports and exports of their products and services in the global market with minimal to no barriers and hopefully not have the financial constraints of tariffs would favor greater growth and greater deal activity in the life sciences industry. There's been the threat of pharmaceutical pricing that would affect the pharmaceutical and biotechnology companies. So they have to find a way of compromising with the government to be able to come up with appropriate pricing to support their billions of dollars they spent to bring a new drug or product to the marketplace. And there has to be more work done collaborating with the FDA in order to streamline drug development, medical equipment, regulatory reviews and approvals. Historically, that's taking significant amounts of time, and the ability under the new administration to hopefully streamline that process and work with the life science companies to bring products to market quicker will enable there to be more opportunity to do deals, because at the end of the day, it's a matter of getting the return on investment, and they have to shorten the time frame of developing a product, commercializing it, and bringing it to market at the end of the day. So time to commercialization of breakthrough biologics and pharmaceuticals, and trying to do all this within the fairly narrow patent protection period is all going to be part of the challenge of going forward. We hope that interest rates will come down. We hope that tariffs will be minimal so that it will allow free flow of cash and investment amongst these companies. But I think as much as there's challenges within the overall research and discovery and ultimate commercialization of very, very unique and challenging life science products, equally what's happening in the global marketplace, both financially and politically, and global trade will also have a significant impact on the ability to do more deals in the future for the life sciences industry.
Bob, to shift gears a bit, love for you to touch upon some of the due diligence considerations when it comes to deal making in life sciences.
Well, I'll start with financial, which is the area that I spend most of my time in. So when companies, private equity firms, corporates, venture capital firms, hedge funds, family offices that are investing in this life science industry, they're primarily focused in a couple of areas: quality of revenue, quality of their gross margins, quality of earnings at the end of the day. They want to understand net working capital and free cash flow. They also really focus on what we refer to as gross to net revenue adjustments. So if you're in the life science industry, there are many different offsets to the revenue that the company generates, such as Medicaid rebates, discounts, chargebacks, sales returns, that could have a significant impact on the ultimate revenue that the company realizes. These are very difficult and complex areas that financially companies want to spend a lot of time performing due diligence on when they're making investments in that industry. They're also concerned about billing, costing, and compliance issues, worried about inventory levels, both in terms of stuffing the channel and accelerating inventory sales, and then having dry periods thereafter, Also worry about inventory, biologics and pharmaceutical products facing expiration dates and or obsolescence. Companies also are very keen on regulatory due diligence, getting that product through the regulatory process, clinical trials, the FDA. They want to do due diligence on intellectual property because at the end of the day, the real value in most of these companies is going to be the strength and protection of the intellectual property. They're concerned about operational due diligence. What's the ability of the company to bring the product from the discovery stage to commercialize and to bring it to market, which is a very complex process. And finally, the commercial due diligence, which is really understanding who is the customer, what is the market, what is the unmet medical need that a life science company would bring a product or service to the market, and is that market large enough to sustain a large investment to give the investor, the private equity fund, the venture capital fund, the corporate partner, the return on investment for making that investment at the end of the day.
What do PE firms generally look for in the buy-side process to better ensure that a mutually beneficial and efficient transaction can be consummated in today's economic and transaction market?
Well, from the private equity perspective, there are some fairly common investment themes, Elana. As I mentioned before, but I think this is paramount to discuss, is they're looking for companies with revenue sustainability and regulatory clarity. You'll find that the private equity firms will tend to invest in more mature, developed companies that have a revenue base, that have cash flow, margin, and profitability, and they'll be less likely to invest in the early stage companies. Their investment horizon is generally going to be much shorter than a corporate partner. So they need to be able to monetize that investment in a relatively shorter period of time. So they're looking for revenue, sustainability, regulatory clarity. They're looking for the quality of that revenue stream. What is the customer base? Is there too much concentration with too few customers for that revenue, or is it spread out amongst a larger homogeneous base? Their preference is for mature companies that are cash flow positive and have operational stability, that have the ability to commercialize their products in a more effective and efficient way over their competitors. They're interested in, like I said, pharmaceutical service companies that don't have the risk of research and development and have a more defined revenue path. They're also interested in lower risk companies such as diagnostic supply and equipment companies that develop testing equipment. And like I said, the contract research organizations, the contract manufacturers that are growing, and we're seeing a lot of consolidation in that sector, fueled to a great degree by private equity investment, because the large pharmaceutical and biotechnology companies want to reduce infrastructure. They want to focus on research and development and the sales and marketing of their products, and get away from brick and mortar, get away from large infrastructures, manufacturing, and more that is being outsourced to these specialty pharmaceutical service companies. So we're seeing a predominance of those pharma services companies being supported and invested by private equity. We're seeing consolidation in that industry because there are a few large players, but many smaller middle market players that, if and when consolidated, can form a very large platform. Private equity is also really focused on artificial intelligence, in reshaping drug discovery and personalized medicine. Oftentimes, you'll see a private equity firm target a larger company, but only a carve out of certain products or services, as opposed to acquiring the entire company. They are looking for turnkey operations, companies that have strong management teams and infrastructure, and that are really more plug and play, that they can make the investment and those companies can integrate into their platform or really become the base company to lead to other acquisitions thereon. So they want a management team in place, they want that product portfolio in place, and a company that's obviously generating positive cash flow and EBITDA. They're also looking for companies where they can consolidate numerous life science companies on their platform to yield synergies and cost efficiencies, because with pricing pressures coming from the government, more and more competition out there with more innovative science, these companies have to learn to continue to improve with their cost efficiencies in terms of bringing product to market, because they are getting continued pressure on pricing, not only from the government, Medicaid rebates, et cetera, but also from the customer base and the consumer that's not willing to pay such high prices for some of these biologics, pharmaceutical products, and medical supplies and equipment diagnostics. And I say lastly, the private equity firm is also focused in on capital expenditures. So in addition to understanding what type of a yield and EBITDA and cash flow the company will put off, what type of CapEx requirements are necessary for those companies to in order to continue to grow their businesses, and what type of further investment will the private equity firms have to make. So that's one of the variables that they use to offset the earnings, the EBITDA, the cash flow that's coming out at the end of the day. They want to make sure the intellectual property is protected as best as possible, and that they have done a proper commercial analysis of competitive products, so they know when they're making their investment that product or service that they're investing in has a lifeline that will give them a 5 to 10 year runway in order to realize the return on investment that justifies their investment.
Bob, we've covered a lot of ground today and wanted to see if there are any final thoughts you would like to share with us.
Well, like I said, Lena, I think that we're going to see more and more transactions in the future. There's a lot of capital out there, as I said, in excess of $1.7 trillion as of the end of the first half of 25 to invest in the life sciences sector in all different forms. We're going to see transactions going forward that are delivering lower risk, quicker timeline to a more reliable, sustainable return on investment, and companies that can deliver to their investors and their customers more cost-efficient medical solutions. I think that if I look at some of the headwinds that the industry is going to face, it's going to be regulatory uncertainty, the ability of the life science industry to negotiate primarily in the United States and in certain key foreign countries to work through the regulatory system to streamline and be more effective and efficient in getting their unique products to the market quicker and less expensively. The ultimate outcome of what happens with tariffs, pricing pressures, and trade tensions, and the negotiations with the government, especially here in the United States, on government pricing, Medicaid reimbursement. There are 3 or 4 key areas that are going to have to be dealt with in order to keep the sustainability of transactions in this industry as vibrant as possible. In terms of the pros, there is great demand for new products, new biologics, pharmaceuticals, diagnostics, and services that meet unmet medical needs. We're seeing record employment in the life sciences industry. We're seeing migration of workforce as well as companies to the U.S. and North America, especially under the pressure of the current administration that is trying to advocate bringing research and development, commercialization, manufacturing back to the United States. So we're going to see more and more investment here in the U.S., more dollars being repatriated and invested, both U.S. companies as well as foreign companies here in the United States. We see strong research and development pipelines, and what we believe with interest rates coming down lower, more favorable tax legislation that's just come out, and hopefully a successful resolution of the tariff and the pharmaceutical pricing issues that would lead to a more accommodative capital environment. So we believe the pros outweigh the cons. It's always going to be a challenge, but there is a strong risk, but high returns, strong returns to invest in the life science industry. The private equity firms do see this as a sustainable investment to bring companies that bring great products to the marketplace that can generate sustainable revenue and margins and EBITDA with less risk. We'll see the corporations, the large pharmaceuticals, the large biotechs that are willing to take on more risk in doing deals with the earlier stage companies going forward. But I do see that we'll see more and more investment in the service companies, the pharmaceutical service companies, the clinical testing labs, specialty and generic pharmaceutical companies, which have far less risk than the ethical branded companies, and some of the select medical device and equipment companies that are putting out more cost-efficient and effective equipment and diagnostics that are helping to lower the cost of healthcare and improve the overall quality of healthcare delivery.
Bob, I wanted to thank you so much for sharing your perspective with our listeners.
Thank you, Elana. I greatly appreciate the opportunity to speak with you this morning.
And thank you for listening to the EisnerAmper podcast series. Visit EisnerAmper.com for more information on this and a host of other topics. And join us for our next EisnerAmper podcast when we get down to business.